In this video, I'm walking through a real-world example of how to underwrite a small commercial retail project. This is the kind of back-of-the-napkin analysis that helps you determine quickly if a deal pencils. For most of the video, you'll be seeing a spreadsheet in the background while I break it all down, but I want to jump on here and give a little quick background first.
This particular project is about 3 acres, part of a larger residential development. Now, for a development of this acreage on a hard corner, having a gas station and a couple of drive-throughs probably would have been the highest economic use, but the city required something along these lines in order to get the residential portion approved. Alternatively, higher density residential could have also been the better economic use here, but again, retail was a condition of approval. So we started looking at how to make this required retail component as financially viable as possible. One of the first things we recommended was adding a drive-through pad. A ground lease drive-through can be a lot more valuable than just more inline retail space, especially if it's unanchored. Simply maxing out GLA is typically not the best strategy. That said, for simplicity, this analysis is based on the original site design. We start by estimating average lease rates for the shop space. This is all spec, so it's based on local comps and broker insight. Then we apply an exit cap rate. In this case, we assume 6%, and that gives us our project value at stabilization. There are tons of videos on rate of capitalization, so I'm not going to cover that here. From there, we back out our total project costs. That includes land costs, site development, building shell, TI allowance, and some construction carry costs during lease up. Now, soft costs and infrastructure costs were minimal here because most of that was already baked into the broader residential development. When you subtract all that from the exit value, you land at a profit of about $3 million. That represents a build to cap rate of 7.59, and with an exit cap of 6%, we had a spread of about 159 basis points.
Now, 150 to 200 basis point spread is typically what most developers are going to be looking for. 159 basis point spread isn't a home run, but it pencils. That said, we always want to run a sensitivity analysis to understand the risk.
So let's jump into the sensitivity analysis portion. The numbers highlighted represent the corresponding cap rate spread for each combination of values. This first one compares lease rates to construction costs. Green means the deal pencils, red means it doesn't. You'll notice how quickly a deal falls apart if lease rates dip slightly or if construction costs run high. Even a 10% swing in either can kill the spread. This next one looks at exit cap rate versus construction cost. If you're banking on a 6% cap and the market shifts to 6.25, your spread gets squeezed fast. So conservative underwriting is key. Here we're modeling land value versus lease rate. Now this was a what-if analysis. They wanted to explore the idea of what they could sell the land for to another developer rather than just developing themselves. If they wanted $28 a square foot for the dirt, you would need lease rates of around $4.50 a square foot per month, along with construction costs and cap rates holding steady to make that feasible. The big takeaway here is prospective income drives the land value. Lastly, this one looks at gross leasable area versus lease rate. And intuitively, more space equals better returns because the land costs and overhead are a smaller percentage of the overall project. However, that is only the case if the market can actually absorb it. More gross leasable area doesn't help you if you're not leasing it up. In this case, adding a drive-through and reducing some inline space was actually a smarter play.
If you own land and you're not sure what to do with it, whether you're thinking about selling it, developing it, or you just want to better understand the potential value, this kind of analysis is a great first step. I offer underwriting and feasibility services as part of my development consulting business, and I can help you create a strategy to maximize the value of your property. If that sounds helpful, head to lindholmcre.com or click the link below and let's talk.